Welcome to the REI Foundation Podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Peely.
Hi, everybody, and welcome to the REI Foundation Podcast with Jason and Peely. Today, we welcome Bill Zahller onto the show. Welcome, Bill.
Welcome, Bill. How are you?
Good. Thanks, Jason Peely. Appreciate it.
Oh, it's amazing to have you. So it seems that we get a common theme, and we love to see it, that we have pilots who make great real estate investors. And Bill is following that trend today. So we're very excited to have you on the show, hear a little bit more about your journey. And why don't you give us just a quick blurb on a little brief background on you?
Okay, yeah. My name is Bill Zahller, and started Park Capital Properties here about a year ago to focus strictly on the multifamily investment side of it. I'd been into single-family rentals. I lived out in Arizona, and I think we 6 of them in Arizona and 2 in Idaho. We basically would build kind of the BRRRR Strategy, I guess. We'd build one actually, and then live in it a little bit till the next one got built on the contract, and just keep. I think I moved 5 times out there in about 4 years. So, and wow. Then kept it as a rental and kept going that way, but kind of phased out of that over time, and came and decided to get in the multifamily. Just the numbers look better, and as a kind of an exit strategy for flying, also to do it full time and make a full time career of that. It works better number wise. So
that's great. Do you still hold those houses?
No, I don't. I've got out of everything out west now, and strictly focused on the multifamily side of it.
Okay. For listeners, give us a little more feedback while you're making this choice to go from single family homes to multifamily home. I think
it's just the size of the deals, the numbers, the cash flow. It's scalable at a much quicker rate than looking to buy one house at a quarter, one house even a month would take a long time, and just the numbers don't quite work out. I guess when you look at the long term plan to my goal is to the next 5 years to have 3,000 to 5,000 units. So it's, at a full-time job, and where I can do with a single family. I don't want to do that much, I guess, work as in finding them and running them and managing them and all that. So just the numbers make sense as a business model, I think.
Well, great goals. I want to learn a little bit more about you though, Bill. What made you get into real estate in the first place? Because you're a pilot. How do you go from being a pilot to a real estate investor?
Yeah, I moved, I guess flying also has almost too many choices. You can live wherever you want because you can just commute to work. So I've lived in a lot of nice places. And when I was moved out to Phoenix, Arizona, I had some friends that lived there in Scottsdale that I knew from Ohio growing up. And they were getting into the investment side of it back then. It was a good time to be in it. And talking to them, decided to join them. And we had like our own little mastermind group. And for several years, that's kind of we all were buying in that area. It was a lot of growth, and it was a good time to be in the market out there. So it was really exciting, and found it was something I really enjoyed doing and liked everything about it. So just wanted to always keep a hand in it. And even when I phased out of that, I, coming back here to Asheville, North Carolina, where I'm at now, ended up buying a short sale. The builders had ran out of money about 85% through, and there was kind of at the downturn cycle of it. So, bought into that and fixed it up and held it for a few years, sold it. But I always just I guess I like how creative you can be at it. It's only limited by your own imagination on what you can do with it and how far you can take it. So,
well said. That's awesome. Yeah. So you have an amazing goal, 3,000 to 5,000 units. How do you get there? How do you get there from where you are today?
Yeah, I think partnering with the right people, having the right coaches and mentors as we go. Of a lot of good networking around here. I found too. Some of the people local here in Charlotte and Nashville that are good-sized syndicators now. They have 4,000 to 5,000 units each. Working with them, talk to them on at least a monthly basis on the different projects here, and then have a mentor who's on my advisory board, Joe for the multifamily side of it, and then another business coach, Trevor, for that side. So, just all in on trying to make sure this all works for me.
Well, let's talk a little bit more about mentorship. You just mentioned Joe and Trevor, and I happen to know exactly who Bill is talking about. He's talking about Joe Fairless and Trevor McGregor. Why don't you tell us more about how both these gentlemen as mentors, as coaches, have helped you like take your business to the next level.
And before you get there, we've actually had Joe Fairless and Trevor both on prior episodes. So
Yes.
Go back and you can hear a little bit more about their backstory, but they definitely are great at adding value and want to dive into a little bit more about how they're helping you.
Absolutely. I guess on the purely on the real estate side of it, I guess with Joe Fairless's program, I've been with February of this year, I guess of 2017. Started with Joe, and it's been great. The one-on-one, running deals by him, the strategic guidance, I guess, and the kind of the big picture. Also, like some of the thought leadership platforms. We started the Asheville Multifamily Investor Club. I started that as a meetup group. It's been a great conduit to have high level people come in. I want as far as brokers from Charlotte, Tony speaking, Zahller from MACC Venture Partner speaking the end of this month for us. So yeah, it's just a great way to network and meet high level people in that arena as far as growing and getting in front of the right people. I guess so. It's been great working with Joe. I recommend it highly, and then the same for Trevor on the business side of it. It's kind of a big picture. What do you need to be thinking about? Where do you need to be spending your time? It's been great with Trevor also. I mean, so their guidance is invaluable, and I look forward to working with them for a long time in the future.
Sure. Let's dive into this a little bit deeper. So you're in single family homes. How do you have 8 homes, and how do you make that mind shift into 3,000 to 5,000 units? Because lots of people they're hesitant just to buy that first home, and now they're hearing that you have a reachable goal of 3,000 to 5,000 units. How do you get to that point where you can just mentally get there?
It did take a little time. It was over time. I read a lot. I enjoy reading. I've read, a lot of people that have, very good books on the subject. The podcast listen all the time. But it's really just, I think, talking to one-on-one people and seeing them progress also through it. As they acquire, more and more units on a, consistent basis. They're doing it full time. And Joe, just as a model, he was, 4 years ago was in the corporate world, and he transitioned to multifamily and, go from basically four houses out there, I think he has, to $190 million in real estate today. I mean, it's impressive. So,
but 190 now.
It is.
I think when we talked to him, it was at like 135.
135, 160. Yeah, it's like a ticker. I can't.
That's it, exactly. Every couple of months.
So, his mind is set. I mean, his mind is set at $1 billion in real estate, and he's already there. In his mind, he's already there, and that's what it takes. So,
but isn't it crazy how you see these mentors and you see other people doing it, and just by seeing other people do it, what's that story with a 4-minute mile? Once it happens, it's possible.
Right.
And that's why mentorship is so key. So key. That's
absolutely. Yeah, I couldn't agree more with that. Yeah, I mean, you see them, you hear it, but in abstract, it's kind of sometimes you hear stories and like, Sam Zell or somebody has billions of dollars real estate. It's amazing, but you don't really know them. But as you get to know people and see them as they progress, it seems much more real, I guess, to me, and having that that one-on-one and actually watching them, say something and then actually turn around and do it also. I mean, they're actively closing on deals, they're actively underwriting, they're actively, searching new opportunity out versus something in the past. It's real time, and you can, ride along and learn from them, and it's been great. Yeah.
That's awesome. And you're in North Carolina, and that's the market you're focusing on currently?
I'm in Asheville, North Carolina. The numbers don't make much sense here as far as the apartment goes. So we're mainly focused in Greenville, South Carolina, and Charlotte, North Carolina right now is the 2 markets I'm most focused on. But they're hour and a half from here, so it's all close.
Sure. And how do you put together finding deals and looking to expand in your market, find your team? Give us some context about how you're forming out your partnerships there.
Right. In the brokerage space, I guess there's been several introductions I've had from either people that I'm working with, like I said, here in Asheville, or some people I know out of some syndicators out of Gastonia, actually. Tony there. So there's been a lot of good contact that way. I've met some people from their teams and other broker contacts that way. So and the networking. I went to the syndicating conference there in Dallas last month, going to the one here in Knoxville that the Jake and Gino are putting on over there. So yeah, again, it's a local area. Yeah. Yep. And going to, of course, Joe's out there in February in Denver, but just trying to be around the right people and the right introductions. And it seems like it's going well that way. meeting a lot.
Looks like we're going to be able to meet you at 2 different conferences. We're going to be both at Jake and Gino's conference and at Joe's.
Okay, great. Yeah. It's coming up here. The 11th and 12th, right?
Yeah. Coming right on us. So, it's great. So, building out, what has been the first step when you're going? So why are you choosing these markets? Why are you looking in South Carolina, in Greenville, South Carolina? What is it stands out about that particular city that you said, well, this is where my focus is going to be?
And to give you a little bit more background on that question, for somebody that's looking for a market, what would you look for if somebody's just starting out?
Yeah, I think it has to be a well diversified job base. There's a lot of jobs coming there. There's a lot of and good paying jobs too. There's some other markets around the North Carolinas here that I can't really put, like Asheville, for instance. I can point to this professional class of, the doctors, business owner, attorneys, and there's hospitality staff. But in the middle there, other than mission health, there's not that many broad jobs. For Greenville, I think there's 241 direct foreign investment in the city of Greenville County. BMW, Michelin, Fluor. There's a lot of large manufacturers, a lot of jobs. It's growing. The economy is growing. The jobs are coming there. So, people are following that. The apartments it's a good area to invest in down there as far as it's a thriving area, I guess, as far as jobs and growth and all that, the economy.
That's great.
Downtown, did a lot of money put in the downtown over the last 5 years. It's and same with Charlotte. Charlotte, I think, is the number 2 financial center right behind New York City, as far as the money that rolls through there. So it's both good areas. Yeah.
So when you're looking for apartment complexes, how do you specify what you're looking for? How do you help yourself along the path where you can help brokers and other people around you know what the right investment is for you? Are you looking for 5 units, 200 units? Is there some kind of parameters that you try and set your sights on that will help you get to your goal?
Absolutely. Yeah, we're looking at between 100 150 unit deals, mainly Class B. Stabilized, so they're going to be at least 95% occupied. So with a value add component to it. So maybe they need to have from RUBS to rebranding them to basically the capex. If you want to renovate the units, you can drive forced depreciation that way. So anything with that kind of play in the 100 to 150 unit range, Class B or possibly Class C in a B neighborhood, something would be interested in. So that's kind of our criteria on that 1980s and newer. And
that's great. What makes it stand out for you? So why 1980s and newer? Why 100 to 150? Where do those numbers stand out for you?
Yeah, some of the older stuff, there's a lot of other issues. I think even as far as functional obsolescence on some of the early stuff, and the neighborhoods, and so a lot of it has more deferred maintenance to the cost of keeping up. But from the the 80s is about where I think a lot of the B product is in that area. So we can still just go in and spend $4,000 to $5,000 per unit, to renovate if the market rent supports it. Can spend that and then drive the. If you spend even like $5,000 a unit on a 100-unit building, would be a $500,000 capex improvement. And if you can increase $75 rent, per unit at that point, you're $90,000 a year at a 6.5 cap. I think it's around $1.3 million forced depreciation. You can add the value to the property that wasn't there before. So that's some things, especially in this market, something of interest to us that versus buying for yield and hoping for appreciation, we can find that sweet spot that. And I think it's the most insulated too. I mean, I've heard a lot of people talk about, the A, if there's going to be a contraction at any point, people are going to give up their $2,000 or $3,000 a month apartments and come back down to that $800 to $1,200 range. They're not building it anymore. I mean, because the price of land's the same, construction's roughly the same. So I mean, it's kind of you have a little bit of, I think, barrier to entry in that class.
That's incredible.
Yeah.
Yeah.
Well, it sounds like your business is doing really, really well. I want to kind of dive a little deeper into it. Can you kind of describe an episode, something that happened in your business that was a great lesson learned for our listeners?
I would, and this isn't on this business, but prior in Scottsdale.
Okay.
It was as far as a harder lesson learned, I guess, would be, I was doing really well in the single family. It was a great time to be in it also. I mean, it was just a great time to be in real estate out there in general. And then we're doing really good because the areas we picked, we're doing well. And then decided to diversify into commercial multifamily, just commercial office buildings. And the guy that who had been managing all our properties there had a large portfolio, managed, probably thousands of units there in the Phoenix area. It all looked right. Went in partnership with him, and it, a lot of delays, a lot of excuses, and eventually turned out we found out it was, it wasn't above board. Ended up in, a couple year lawsuit over it. Wow. And my timing was right. Luckily, it was just pure luck that I got a settlement. And then 6 months later, there was a guy behind me, much bigger player, apparently out of, I think, Salt Lake, that didn't settle, took it all the way, and it closed up that other company from fraud and other allegations. So I guess the lesson there is to be very sure who you partner with on deals. I didn't apparently do enough due diligence that it looked right. There's a lot of stuff happening, a lot of current things, but it didn't work out. Well, it ended okay for me, but it was, like I said, it was just luck on the timing. If I'd been reversed and been behind the other guy first, I would have got nothing back out of it, which was, several $100,000 invested in it. That would been a painful lesson to learn.
Yeah, well, I don't want to rip off a Band-Aid, but let's go back there a little bit and just we're trying to help people that if they are partnering with someone, what would be something that you would do today to better, we'll say, analyze that partnership, do a little better due diligence? What were some things that you things can always be missed, and sometimes it's of course it's hard to always know, have the crystal ball, but what would be some things that you think now today that you would have done differently?
I definitely should have vetted the group better, I guess. I was familiar with them because I was using them as a property management group. It worked fine for that. I could see the scale they had. He was a well-known guy out there at the time. It all looked good on the surface, but I would have needed, I guess I should have gone and seen other business deals he'd done, talked to other partners he'd had in the past, how they'd worked out, currently and as it turns out, he didn't have much experience in the commercial side of it either. So that was should have been a red flag, I guess, for me, that he was very successful in the residential side, but didn't have that much in the commercial side, and was just trying to make some money on the spread between there, and it didn't work out. And but there was an honesty factor in there too, of course. But from my point of view, I definitely should have made sure I had seen some of the deals that I had, talked to some partners that had worked with them before in that type of deal, not just in real estate in general, but specifically commercial real estate. And I think some of that could have been avoided. There probably were signs, missed them at the time. In hindsight, it's much clearer, but
no, that's great, because honestly, what you said there is that success in one space, whether it be single family homes or trailer parks, doesn't necessarily mean that you can multiply that success into a different space, because it's a whole different beast. And I find myself always having shiny object syndrome where, one day I'm here, the next thing I'm buying this. And that's why I have this one who is at the starting line, so I don't get too far into it, because if next thing you know, I'll have, 3 car washes, a donut shop, and a restaurant.
Right.
Like, what just happened, But
absolutely. And he was a good salesman. I mean, just in general, was a charismatic guy, and, that all sounds good. The numbers they showed were good, but, it didn't work out. It was more like a pro forma that, here's our best case scenario. And it didn't pan out to that. So, but, lesson learned from that. And
so I would say that you hit on a key point there. So that he gave you the best case scenario, which of course, sure, we all want that, but you're now syndicating your deals going forward. So when you're presenting to your investors, how do you put together a presentation that one gives them the opportunity that's in front of you, but on a realistic scale? How do you preface this?
Right. We're not basing anything on, like a lot of stuff now you see, I think, underwritten kind of at like the best case, like I use Dallas, I hear that a lot as an example, but, rent growth has been, 7 or 8%, and people project that out into the future, which it obviously can't continue. I mean, the jobs increase isn't happening at the same rate. So they just can't have a divergence of income and rental growth at the same part. So we'd always underwrite to like the long-term average, anything long-term cap rates. I wouldn't expect them to continue to compress. Obviously, I think at some point they're going to reverse, and the prices will start coming down on these assets. So I mean, like the long-term average of that, at least 50 basis points higher on that, or some of the more conservative underwriting do like a quarter per year. So if you had 5 years, you underwriting at 1.25 higher cap rate on your sale on the exit. So just trying to be conservative on all the underwriting to make it realistic as possible. And then we always hope to, of course, the under promise and over deliver side of it versus best case, broker pro forma that, if everything works perfectly, this will happen, but it seldom does. So
that's amazing.
Yeah. Try to definitely make sure we can mitigate the risk the best we can and all the things that are controllable on our part.
Let's talk a little bit more about the underprice and over deliver. How do you go about doing that? How do you protect yourself in these properties?
I guess picking the correct market on the macro level first. Make sure we have the right market, the right jobs. Nothing's tied to like any one industry. There's an example, of course, of Detroit with automotive or Houston back in the 80s. Anyhow, with the oil, anything that's too dependent. 30% one market. Obviously, we don't want anything like that. So a lot of good jobs and diversity of employment, not just one employer on that economic side of it. And then just the asset, like I said, if the B, I think, has a special niche in there that people will come down from A, but there won't be as many concessions, I think, toward the B product because you can't build it and they're going to live somewhere and they're not going to go down to C or D neighborhoods, certainly. Yep. So I think you have some insulation in there for several years anyhow until 10 years from now, the current A stuff will start moving down to B. But I think you have a good runway there as far as into the future, as far as things we can do. And then, if it's cash flowing, stabilized properties on day one, so we're not looking to turn it around. If we can't fill it up, then we have a problem. It's already, going to be, 90, 95% occupied. We're just going to take a good business and make it better.
That's great.
Nice.
Yeah.
So why would you focus on properties that maybe don't have so much upside, but instead of properties that maybe are 60% occupied or have $25,000 a unit CapEx in there? What would be differentiating for investors looking to get into this space?
Yeah, I think it's mainly the your appetite for risk, I guess, on that. I'm looking for definitely a more stabilized, like I said, from day one, have a cash flow. So, there's a lot of debate where we are in the cycle, and most people, I think, would agree that we're probably closer to the top than we are the bottom. So if the market does turn, we can always just stop doing renovations, cash flow the property for a few years until the market picks back up, and then we can continue the renovations. But it's not that if we get timed wrong, like flipping a house or something like that, if you right at the very top of the market and you can't sell it and you're stuck with it, this way at least we can just hold tight cash flow, and then when it picks back up, start back the renovation. So I think it's a safer business plan. Like I said, there is always the risk reward ratio, but I think I can sleep at night with this plan.
Yeah. That's great. Important.
Yeah, yep. No, most definitely. So we've deep dived into your business. Now I want to go back and deep dive back into you. Mm-hmm. And this is a question we love to ask everybody. What is your big why? Why do you do this?
Yeah, well, I love real estate for one, and I love the, like I said, how creative, and you're only limited by your how creative you can be, your ability to see things and solve problems. Like I said, the other profession in flying, it's, it's all pretty much set. It's all, written in stone ahead of time. There's only so much you can do. I'm at the top of the game in that market already. And for the next 20 years, I don't want to just stay there. I want to, continue to grow and do new things. But one of the other main reasons, I have 3 little girls. So I want to have a business I can leave to them. And if they want to work with me in the business, they get older, that'll be great also. But it buys you freedom, I think, the time and the freedom. The money will buy time, and be able to take off for a couple months in the summer and go to Italy or somewhere you want to go. Just be able to enjoy life, I guess, versus being on somebody else's schedule and plan.
Freedom and time.
Love it. Yeah. So you get to these 5,000 units that you're going to be at in year 5. Where's your end game? Where do you go from there?
10,000. Yeah.
I love it.
That's
easy.
Yeah. We just double that. Yeah.
Do it. Double down.
Platform, but yeah, like I said, it definitely do be full time. Doing it full time,
right.
And get around that critical, I think, mark of 3,000 to 5,000 units. I think would allow I would definitely look at other options at that point, as far as if I want to have a property management company in house or something along those lines that would dovetail into the current business. It would also feed it. If you're managed properties and off market, you could find out if somebody's interested in selling, or there's certain things I think that benefit your business as a whole, also with being more connected to to the industry that way. But yeah, it's
great. So if this is the first time someone's listened to a real estate podcast, give us a piece that would be something they could do today to get started actively in multifamily.
Right. Well, if there's a podcast, they have an interest in the education, continue to listen to podcasts, read, all the usual things. But I think the main thing would be to get out actually in the space and network with people. You never know who knows the person you need to know. I mean, so I think it's incredibly important to, go to the meetup groups, the real estate CREA meetings, the different conferences we're talking about. I think I think that's, let people know what you want to do. I mean, a lot of people, they show up and they're just kind of listening, but, tell people if you want to get into multifamily, that's what you're looking to do. And there's going to be somebody at the meeting that can point you to the person that's doing that at a higher level than you. And I think it's Tony Robbins that always says, success leaves clues. So, yeah. Follow that person and learn from them. And most everybody I've, like I said, reached out to that are doing it at a high level, they've been more than generous with their time. They're all willing to help. Like I said, Tony there is coming down in 2 weeks to speak at our local meeting here in Nashville about property management and syndication in general. So they've all been, super, super helpful on anything you'd ask. And I've been really, really surprised and pleasantly surprised.
We started a meetup here and it's been amazing, strictly designated for multifamily. And it's just amazing the value that has come from there. And we've had great ideas come from people who have a ton of property and people who first meeting. And it's been just incredible, the energy. So yeah, kudos to you. That's an awesome step.
I think it's important. I actually wrote one of the little articles I wrote on my blog was about being around like-minded people, just the ideas you get just from being around the people. I mean, as much as the conference I went to, it was the people I met there that were doing things at a higher level. And it just, was motivational, like I said, the ideas that they come up with or just talking to them that you come up with, as you're in that kind of environment, I think is critical to advancing.
A few more questions before we let you go. So what are some words you live by?
As far as like quotes and sayings, I think actually this comes from Trevor, but it was the lions don't lose sleep over the opinions of sheep. I always let that quote over my office headboard up there but I think that's a good quote that, do your own thing and, know what your goals and vision are and stick with them. There's always going to be people that, aren't on board with it, but, time takes care of that. So, yeah.
Thank you for that. That's fun. We love it. We love it. So if people I would like to reach out and hear a little bit more about your story, talk to you a little bit more about what you're doing, what's the best way for them to reach you?
My website, parkcapitalproperties.com, or my email would be bill@parkcapitalproperties.com.
Great. Your blog's on there as well?
Your blog's on there, LinkedIn account, Facebook, all that links from that page. So phone numbers on there. Everything's feel free to reach out and be glad to have a conversation with anybody that's interested.
Oh, that's great.
Perfect.
That's great.
Well, thank you so much, Bill, for being on our show. It was a pleasure having you, an honor.
This is great.
Well, thank you guys so much, Jason and Peely. It's great. I love your podcast, and thanks for everything you're doing to get the word out, and I appreciate it.
Well, thank you so very much, and thank you to all the listeners out there. So this is Jason and Peely for the REI Foundation podcast. Thank you again so much to Bill Zahller for being on our show. Bye now.
Bye now.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.